So, yes, this we are doing advanced consolidation. So it's not the FR consolidation that you just acquire a subsidiary and that you assume that you are going to be with the subsidiary forever. No. Okay. So there can be a situation where the subsidiary is not doing well and a parent will decide to dispose of some of the what each shareholding or dispose of the entire shareholding or uh, dispose of majority of the shareholding. So if you have shareholding in the company and the company is not doing well, or you people you need money and you don't know where you are going to be getting the money from, you can decide to dispose of part of your shareholding in that particular company. So we have a situation where uh, a parent is going to have shareholdings in in a particular company, and along the line, they don't want to keep their investment over there again. So they will decide to sell their investment. They can sell the entire investment, they can sell majority, or they can sell and still have majority. So if a situation like this happen, how do we account for it? That is what we are coming to look at. So, oh, so company A can have shareholding in company B, which will be 90%. Okay. So along the line, company A can decide to dispose of company A can decide to dispose of let's say 30% of what of the shareholding. So after the disposal, what will be the shareholding after the disposal? What will be the remaining shareholding in what in B? What will be the A
60.
shareholding? Okay. So the remaining will be 60. Okay. This 60, the remaining shareholding will be 60. That is 60. Does A still have control over B?
Yes.
Yes. So he's still having a shareholding that is more than 50%. So you are still, after disposing the shares, you are still the majority shareholder. So you still have control over these people. So if there's a disposal and there's still a control, how do we go about it? All right. The, sa- the same way, the same way the A can be having 90% shareholding. A can be having 90% shareholding, and A will dispose of 60%. Okay, what will be the remaining after the disposal?
30.
Okay, this particular 30 cannot give control, isn't it? So there is a loss of control there. So you cannot from the date of the disposal, you cannot consolidate you don't even have subsidiary again. So you cannot consolidate them. So it means that you have disposed your investment and you have to find a gain or loss on that particular transaction. So we'll be looking at a disposal from control to control and from control to non-control. Okay, this is the remaining. If after disposal your shareholding is still more than 50% or you are still having control, that is from control to control. But if you are now having 90, you have 90% and you have disposed 60% and you're now having 30%, it means that you have lost control over the what? Over the subsidiary. It's just like you have a shop that you decide to sell 60%, or you are the owner of the shop and you decide to sell 70% of the shop. It means that the shop is no longer your own. So you have disposed of the shop. You have sold the shop, and the shop, you don't have ownership over there again. So you have to find profit on the what? on the sale because the shop is no longer your own. But if you have a shop that you have disposed 30%, it means that you are still the owner of the shop. So the shops has not been disposed. Okay. So that is how we go about it. If it is from, so we'll be looking at from non-control, from control to control, not non-control. Okay. From control to control. How do we account for it? So from control to control. Okay. So from control to control is a situation where after the disposal, the company will still have control over the other one. So let's use this situation. So so what will be the NCA here? What will be the NCA portion over here?
10%.
Okay. So NCA will be 10%. Okay. So let's see on July 20, on July 1, okay, on July 1, 2023, okay, A disposed of 20% of each shareholding. Okay, these 20%, who are you selling to? The people that will come and buy the 20%, they will still form part of what? NCI. Okay, they will still form part of the NCI because you are still going to be having a control. So you'll be having 70% now. That 30% will be owned by different people. So this will still form part of the NCI. So a situation where after the disposal, you are still having control. There is no way you can calculate again because you have not disposed of what? Your investment. You are not selling your investments. You have a shop that you are the sole owner of the shop and you have disposed 20%, you are still the owner. So you can't say you have sold the what? The shop. You are still the owner. So there's no disposal. You don't have to find profit. The situation where you have sold 80% to me, it means that the shop is no longer your own. You have disposed of the shop and you have to find again. So if the disposal is going to result in a control again, we will still consolidate because we still have control over the what? Over the subsidiary. So we consolidate them. But what will happen is that if you want to count to the share of the profit, if it is sharing of profit and you want to share the profit for this year, okay, you are going to be having two sharing. So from January to June, the parent will be having what percent of the profits?
90%.
Okay. The parent will be having 90%. NCL will be having what?
10%.
10%. Okay. But from July to December, what will happen?
The parent's share will now be reduced to 70%.
So the parent will have the share of the profit 70% from July to December, and NCL will now be what? Be
30%.
30%. Okay. But how do we account for the disposal? The parent is going to receive what? The parent is going to receive money. There will be process. So what portion of the asset are we selling to the NCI? How do we account for that? It is accounted for like the way we account for what? Control to control under step acquisition. The transaction is going to be between the NCI and the parent. Any difference over there will go to other component of equity. So what we do is the accounting treatment. The accounting treatment will be you look for the process, the cash process that you are receiving, the parent is receiving from the NCI. Okay. So what is the portion? What is the transfer to NCI? So you look for the transfer to the NCI. How do we calculate that? It's very simple. Okay. And this one also depends on if the NCI is measured at a fair value or a partial or as a proportionate value. Okay. So you look at the transfer to the NCI, then the difference over here, whether it is positive or negative, will go to other component of equity. There is no gain on this one because you are still the legitimate owner of the entity. But how do we know the amount that we are going to transfer to the NCI? We look for the parent portion of the net assets at the date of disposal. then we find the percentage of it. Or this is what you do. Okay. Let's say that uh we have, okay, so let's say there is a two of us, okay, A and B. We have okay, we have 100 rooms. Okay, the two of us, we have 100 rooms. Okay, let's say that we have 100 rooms, that you are having 80% of the 100 rooms and I'm having 20%. Okay. All right. You decide to sell 10% of your holding to me. Okay. You decide to sell 10% of your holding to me. Okay. So let's just use rooms as an example. We have rooms, and out of this room, you have 80 and I have 20. You decide to sell 10% of your room to me. Okay. If I want to know the 10%, the number of rooms that you'll be giving to me for the 10%, I have to calculate this like this. Okay. I can also have the number of rooms that you are going to be selling to me, which will be the 10%. Okay. I can do it like this: 10 over 80. Is that correct? You are having 80, you are having 80% of the rooms. So the rooms that you'll be having. So let me just use numbers. Okay. Let me use. So A will be having how many rooms? So A will be having 80 rooms, isn't it? Okay. And B will be having 20 rooms. That's how we are going to share the rooms. Okay. A now decide to sell 10% of the rooms to what? To B. Okay. So we want to know the number of rooms that A will be selling to what? Selling to B. So it means that the 80 rooms represent 80%. Okay. So we can say that the transfer will be 10 over the 80%. You are selling 10% out of the 80% that you have. Okay. So that will be calculated as 10 over the 80% multiplied by 80. How many rooms will be given to? How many rooms will be given to B for the 10%?
That's 10 rooms.
Okay. That will be 10 rooms. Okay. Okay. Can we also say that A will now be having 70% of the rooms and B will be having 30% of the rooms?
Yes.
Okay. So we can also say that the rooms that A is selling, the transfer will be calculated as just 10 over 100 multiplied by the number of rooms that we have. Would that also be 10?
Mm.
Okay. Or we can also say B is now having 30% of the rooms. So 30% of the rooms will give us what? Will give us 30.
30 rooms.
Okay. But B is already having 20 rooms. So the rooms that will be selling to B now will be 10 rooms. Or you just find 10 over what? 10 over 100 multiplied by the total number of rooms that we have. Okay. So what you'll be using in the exam is just what? The portion that the parent is selling multiplied by the total net assets. Okay. The total net assets of the subsidiary at the date of the disposal. So you have to find the net asset at the date of the disposal. But the question is, if the NCA is measured at fair value, it means that NCA will have the share of the goodwill too. So if NCA is measured at fair value, all right. So it's very simple. You will now be having 10% of the total rooms, which is the 10 rooms, or you can find 10 over 80 multiplied by the 80 rooms. You will still be having 10. You can find 30% of the total rooms. So you have 20 rooms already. So the difference is now the rooms that you are purchasing from the A. Okay. So if the NCI or if the parent is using a partial goodwill method, okay. So this one depends on. So if we are using a partial goodwill, means that NCI is not having a share of the goodwill. Okay. So your calculation will be, let's say, the transfer to NCI will be the percentage just multiplied by the net asset. The net asset of the subsidiary goodwill is not part. So if NCI is measured as a proportionate of the net asset, it means that NCI is not having any share of the what? Of the intangible asset, which is the goodwill. So if you are selling, you will not transfer a portion of the goodwill to the NCI. So you just find the percentage on the net asset. That is the amount that you transfer to the NCI. But if we are using full goodwill method, if you are using full goodwill method, which is NCI is measured at a fair value, full goodwill method, it means that NCI is also having a share of the intangible assets. So the transfer to the NCI, transfer to NCI should be the percentage rate multiplied by the total net asset, including the goodwill. So NCI, you are selling part of the goodwill also to the NCI. So you add the goodwill to the net asset at disposal and find the portion of it. Okay, so we are going to be having this percent multiplied by the total net asset, including the goodwill. Okay, so total net assets plus goodwill. Okay, at the date of the disposal. So this is how we go about it. The difference that you are going to be having. If you are receiving 200,000 from the NCI, that is the process. But the net asset that you are giving to them is 180,000. Okay, there will be a difference of 20,000. This 20,000, don't recognize the 20,000 as a gain. No, you haven't disposed your investment. So you send it to other component of equity. Let's pick an example there to see a short example there to see. Okay, question number 3. Question number 3. You can see the one over there. Okay, so that let's take that short one and see. Then we move on to other issues. All right, someone should take that question, that simple one for us.
Until 30th September 2017, Juno held 90% of Hera. On that date, it sold 15% for 100,000 Ghana cedis. At the date of the sale, the net assets of Hera were 650,000 Ghana cedis, and the goodwill was 150,000 Ghana cedis. It is group policy to measure the NCI at fair value at the date of acquisition. Required. Demonstrate how the disposal transaction should be accounted for in the Juno Group financial statement.
Okay. So this one is they have. Okay. So they say demonstrate how this would differ if group policy was to measure NCI at a proportionate net asset method. Okay. Okay. So we can see that the parent was having what 90%. Now they have sold what 15%. They will still be having control, isn't it? Okay. So we will now look at so let's just look at illustration. That is question number 3. Okay. So what we need to know the transfer. So let's come to the cash proceeds. How much was received from the NCI? How much was the 15% sold for? Okay, that was 100,000. It was sold for 100,000. Okay. So we need to know the transfer to the NCI now. Okay, transfer to NCI. What is the portion that we are transferring to the NCI? Okay, let's come here. Okay, the net asset at the date of disposal is what?
$50.
Okay, and so are they using? They say it is a group policy to measure the NCI at fair value at the date of acquisition. So we are going to be disposing the physical asset together with the what? With the net asset to together with the goodwill to the NCI. NCI will have a share of the goodwill also. So what will be our total net assets? Total net assets including the goodwill.
800.
Okay, so we have 0.15 multiplied by 800,000. NCI will now be having additional 15%. So how much are we getting?
120,000.
So we are transferring 120,000. Okay. So you can see that we are transferring more than we are having, isn't it? Right. Don't recognize this as an expense. No, it will go to other component of equity. Whether it is positive or negative, it will still go to other component of equity. Okay. Another way of doing this is that you can also now find the portion of the NCI. NCI will now be having 25% of the net assets. Is that correct? NCI will now be having 25%.
Yes, please.
Okay. If they are having 25%, that will be 0.25 multiplied by the 800,000. But they already have 10%. So what is bringing the additional holding? It is a 15%. So just go ahead and find a 15% of the assets there. Okay. This is the A part. Okay. B part, they are saying that if they are using proportionate method, that will be a partial goodwill method. Okay. So we still have the cash process of 100,000. Okay. But what will now be the transfer to NCI? Okay. What will now be the transfer to the NCI? The transfer will only be 1.5 multiplied by the only the net assets, because NCI will not be having, we are not selling part of the goodwill to NCI because they don't have any share of the goodwill. So you just calculate your 15% on the net assets of the subsidiary at the date of disposal. And that will give us how much?
97,500.
Okay, so we have 97,500. What will be the difference? 2,500. Okay, so this will still go to other components of equity. Okay, components of equity. So the parent will still consolidate because they are still having control. But the only thing is that from a point, they are going to be having a 90% share of the profits. And if at a certain point, they will now be having 75% of the what? Of the share of the profit during or after the disposal of the 15%. So this is control to control. You dispose and you still be having control over the subsidiary. So you still consolidate them because you still have control. So the consolidation will still continue. But just that the share of the profits will be splitted into two. A portion you'll be having 90%, a portion you'll now be having 75%. So this is just about the control to control. Not difficult, very simple. Let's come to from control to non-control, a situation where the parent will dispose of majority of the shareholding, which will now be making them not to have control over the subsidiary again. In this case, the parent can decide to dispose of the entire shareholding. So from control to non-control, the parent can dispose the entire shareholding. So you can dispose the entire shareholding and you're not going to be having any shareholding there. So that is a disposal, and you have to find a gain on the disposal. Okay, you can majority of the you can dispose majority of the shareholding. So majority of the shareholding. Okay, so we can also dispose parts of the shareholding, but that will also be giving us what? That will also be making us to lose control. Okay, so the parent can dispose of all the 90%. The parent can dispose of 60%. The parent can dispose of 55% or 58%. That will still be giving them what? There will be a loss of control, no matter how the disposal, whether it is an entire one or not. If it is an entire one, we are no longer having any investment there. Okay, we can lose control, but what will happen is that we are going to be having maybe 20 or more shareholding there, but it will be less than 50%. Okay, so it will be less than 50%. So the question is, if there is a loss of control, how do we account for the what? The remaining interest there. So we can dispose. Okay, let me speak yes. Okay, so we can have 70% and we decide to dispose of all the 70%. We don't have any shareholding there, so we don't have any business with those people. Okay, so you dispose of all the 70%. It means that you don't have any, you are disposed of all your entire investments, so you have to find a gain on it. Okay, we can also dispose 40%. Okay, let me just say we can also dispose of 50%. Okay, or let's dispose of 55. So we can dispose of 55 and be left with only 15%. Okay, we can also dispose of 40% and be left with 30%. Okay, the question is the remaining interest. How do we account for it? We say that any interest that is between 20%, and let's say that is between 20% and 50%. It is between. So it can be 20 up to 49.9%. Since it's not 50%, you don't have control. So any holding from what? 20% to 49 or 49 point, not 50, between those two. Okay, that particular interest will be giving you what?
Significant investment
Okay,
or
so
significant control.
okay, so you'll be having associates. So you account for your 30% as an associate. Okay, you account for this as an investment in associate, which you now be using the equity method. But if you have 15%, this is now will be a normal interest. So that will not be just a mere investment, which you'll be using IFRS 9. So you can be using, this is investment in equity. So you can try to carry it to profit or loss or other comprehensive income. It's a financial asset through equity instrument. So we have only two classifications, either through profit or loss or other comprehensive income. So if your remaining interest is less than 20%, that will be accounted for as a financial asset. But if it is more than 20% or 20% and above, but less than 50%, that will be accounted for as investment in associates, like the normal investment in associate that we know. But since you are going to be losing control, it means that you have disposed of your what? Your investment. So you have to find gain on it. How do we calculate the gain? That is the issue now. Okay, let's say we have 70%. Okay, so our net asset at disposal is 200,000. Okay, our net asset at disposal is 200,000. So you also have the goodwill. So the net asset will always be excluding goodwill. Okay, the goodwill is 30,000. Okay, the value of NCI, let's say the value of NCI is 50,000. Okay, the cash process, the amount that we have received from the disposal, let's say the amount that we have received from the disposal is Okay. The amount that we have received from disposal is 120,000. Okay. We dispose of only 40%. So it means that 30% will be remaining. The question will always give you the fair value of the remaining interest or the retained interest. So we say that the fair value of the remaining, so the fair value of the remaining interest of 30%, the question is saying that that is 80,000. Okay. All right. So the question now is, how do we calculate a gain from these particular investments? Since we are losing control, it means that we are selling the goodwill also to what? To the company that will now be what? That will now be the parents. Okay, so we don't have any goodwill also over there. So our total net asset at the date of the disposal will be how much? The goodwill is relating to the subsidiary. Also, what will be the total net assets?
230,000.
Okay, but this asset is for both the parent and then the what? The NCI. Okay, so if NCI is 50,000, what portion of the net asset will be for the parents? The 230 is for is
So
180.
180.
that will be 180, isn't it? Okay, so the net asset relating to the parents, the net asset relating to the parent will be the 230 minus the 50. That will be 180. Okay. So they are saying that the fair value of the net asset that we are not selling. Okay, we have 70%. So they are saying that the fair value of the 30% that we are not selling is 80,000. Okay. So what is the value of the what? What is the value of the 40% that we are selling? If our 70% is 180 and the 30% that we are not selling is 80. So what is the value of the 40% that we are selling? The net asset relating to the 40% that we are selling. That will be how much?
72,000.
No, they have given you, don't share this one by 30 and 40. They have given you the value of it. The fair value of the 30% is 80,000. What is the portion of the 40%?
60,000.
No. The 70% is 180. Okay. So you are selling only 40. Okay. The 70% holding, is 180. Okay. So this 70%, we have 30 and 40. Okay. They are saying that the 30 is now 80,000. Okay. So what will be the 40% now? Would that be 100,000?
100,000.
Yeah, that would be 100,000. Okay. So you are
That
selling
will be
only, you are selling only 100,000. For how much?
for 120,000.
Okay. So you are going to be having a gain of what? You have a gain of
20,000.
20,000. Okay. So how do we calculate this one now? Okay. So all the things that we have done right now, how do we calculate it? Okay. Let's come here. I will just put this thing for you over here. But the issue is you need to understand whatever we are doing. Okay. So the gain on disposal, how do we calculate the gain on disposal? Okay. If control is lost, you are not going to, if you are doing statement of financial position, you are not going to consolidate that particular subsidiary again because you don't have control over them. But if you are doing statement of profit or loss, you consolidate them to the time that control is being lost. Maybe you have sold them, you have sold your 40% on 30th September. It means that from October to December, you are not going to consolidate them, but you consolidate from January to September. That time you have a control over them for 9 months. So how do we do the disposal over here now? How do we calculate the disposal? It is calculated as the look at the
making sure the man is mentally okay, even though she's
we are going to be having, so we have so let's have the net assets. So we look at the net assets. So we have the net assets. Okay. So we have the net assets of the 200,000. 200,000. Then we add a goodwill to it. That's what we have. So we add a goodwill of 30. We have 230. Okay. Then what happens is that we take the NCR from it. Okay. So we take the NCR of 50,000 from this. Okay. We also take the 30% of the remaining shareholding. So 30% return. So return interest. We also take the 80,000 from here. Okay. So we take the 80,000 from there and we have 100,000 of the 40% interest disposed. Okay. Disposed. Then we now compare with the cash process. Okay. We now compare with the cash proceeds of 120,000. And we now have a gain of 20,000. This gain will go to profit or loss as a line item, or if you are doing statement of financial position, you send your 20,000 to return earners. Okay, let's look at this one. Can we say that this can also be calculated like this? So we have the cash process. Okay. So we can have the cash process to be 120,000. Okay. What are we doing to the NCI? We are subtracting the NCI and the return interest from the net asset, isn't it? So we can decide not to subtract. We can decide to add D to what? To the cash process, because whatever we are going to be doing, this should be subtracted from the 230. So if you don't want to subtract, you can add it to what? To the cash process. So we can add the NCA over here, so that if we add it over here, you bring the total net asset, it will just cancel itself. So we can bring the NCA over here as 50. Then we bring the what? The return interest over here also as 80,000. Okay, what is the total that we are getting? We are getting 250,000. Is that correct? Okay. So you just bring your net assets. So you bring your net asset of 200,000. Then you just add your goodwill to it of 30,000. So you now have your 230,000. Okay, then you have 20,000 as a gain. Okay, so instead of you subtracting the 50 and then the 80 from this one, we just add it because it's already included in the net asset and then the goodwill. So adding it to this one means that we are going to, it is going to be having a zero effect. We have 80 in the net asset for the return interest. We have 50 also in the net asset. So you adding it to that particular means that you are neutralizing what? The effect. So you just increase that one by what? This one. And this is what you are going to be looking at. So for you to find a gain, you pick your cash process. You pick your cash process, the amount that you have received for the disposal. You add the fair value of the NCI at the date of disposal. Then you also add the fair value of the interest return. You add it at the date of disposal. Then you now take your net asset at the date of disposal and also the goodwill, because since you are disposing, you are not going to be having anything to do with that one. The goodwill will now be sold to the new company now. So you have the goodwill here. Then you subtract the 2 from your total, and that will give you a gain. Okay, that particular gain will go to profit or loss as a line item, gain on disposal of a subsidiary. But if you're not doing statement of profit or loss, it will go to statement of it will go to group return earners if you are doing statement of financial position. But the issue is how do you account for the remaining interest of 30%? So the 30% will now be investment in associates. So let's say you have done 9 months. You have done 9 months before the disposal. So for the first 9 months, you have control over the subsidiary. So if you are doing statement of profit or loss, you are going to consolidate them for 9 months, which will be 9/12 multiplied by their revenue, their cost of sales, their administrative costs, their distribution costs, their finance cost, their tax expense. You consolidate them for what? 9 months. You are going to have a 9-month share of the profit as a parent. So you consolidate them for 9 months. But for the remaining 3 months, you will now account for them as investment in associates. So you only show a share of what? Your profit from the associates. So which will be the 3/12 multiplied by the profit for the year, then multiplied by your percentage of 0.3. So you just find only your share. If you are now having associates, you just take your share of the period that you have them as an associate. Then you send it to your statement of what? Of profit or loss. So if control is being lost, you consolidate them to the time that the control is lost for profit or loss. For statement of financial position, we don't do pro rata. At the end of the year or at the reporting date, you are no longer having what? Control over them. The assets are not owned by you. You don't have control over the liabilities. You are not assuming their liabilities. So we don't consolidate them in statement of financial position. It's only in statement of profit or loss that we show what portion of the profit should we have as what? As parents. So you consolidate to the date of what? The loss, and the remaining one you just account for it as financial instrument if the return interest is lower than 20%, but if it is more than 20% but lower than the 50%, then you account for it as investment in associates. But we have looked at the first situation where you sell but you still be having control. It means that you still consolidate them like normal, but the transaction will be between the parent and then the NCI, and we have done that. So that is basically about the disposal situations. So they can give you a question on statement of profit or loss, which is always the case for the disposal, but they can also give you statement of financial position. Okay. So if they are giving you statement of financial position, then maybe they will give you more than a subsidiary so that you can consolidate the other subsidiary. But the second one, if control is being lost, you cannot consolidate them in the statement of financial position. So statement of financial position seems to be maybe easy as compared to statement of profit or loss. Let's pick a tutorial question and see whether we can finish it within the next 1 hour. Then we solve. So we do one question on profit or loss and one question on statement of financial position. Let's take question number 8. So what do we do? You know that who will be the parent here?
ZP.
Okay.
ZP.
So you don't even have to read this thing again. So you just go to your, so you have your ZP group. Okay. So we have the consolidated statement of profit or loss and other comprehensive income for the year ended. Okay, so let's look at the reporting date. The reporting date will always be the date at the top, 30th June. Okay.
Please, senior question what?
Question number 8. 30th June 2016. So let's have the revenue here. revenue. What is the parent revenue? 420. So we have 420. Then we have cost of sales. Cost of sales to be 304. Then we have the gross profit. Gross profit, we don't bring the figure because if you do your adjustment very well, you have your gross profit. Okay, so we have the investment income. So let's have the investment income. So what is the investment income for the parents? $42. Okay. So we have 42. So you can have profit on disposal if there is any. So profit on disposal of a subsidiary if there is any. So we don't know. Okay, but we know that this is a disposal question. So maybe there can be a profit on disposal. If there is none, you can put 0 there. So we have the administrative cost. Administrative cost will be 22. So let's have admin cost to be 22. We have other expenses or other operating expenses. So other operating expenses. Okay. Other operating expenses to be 34. Okay. So we don't know what will happen. Maybe the parents can lose control. Since this is disposal, the parent can there can be a loss of control and they will be having investment in associates. So you can also bring a line item that will be share of associate profits. If there is none, you just put 0 there and move on. Okay. So if there is nothing over there for them, we can just move on. So we now have our operating profits. Okay. So let's go to, you have their operating profits. Okay. Then after the operating profit, what do we have? We have finance cost there. Okay, we have net finance cost. So we have the net finance cost of 2. So that is 2. Okay. Then we have profit before tax. Profit before tax. So let's come to the tax expense. The tax expense that will be 30 for the parents. So we have 30 for the parents. Then we go to the next item. That will be profit for the year. So profit for the year, don't bring anything because if you put your figures together, you get, these are resultant figures. So you don't have to bring them. So profit for the year. Then we have other comprehensive income. So other comprehensive income, we now look at the items that are there for the other comprehensive income. We have the gain on property revaluation. Okay, gain on revaluation. So that was 14 for the parents. Okay, so we cannot take, so you cannot start with the footnote now. Okay, so someone should take the footnote for us.
On 1 July 2014, ZP acquired 60% of the equity interest of Guinea, a public limited company. The purchase consideration comprised cash of $90 million, sorry, and the fair value of the identifiable net asset acquired was $114 million at that date. ZP uses the full goodwill method for all acquisitions, and the fair value of the non-controlling interest in Guinea was $50 million on 1st July 2014. Goodwill had been reviewed annually for impairment, and no impairment was deemed necessary.
So what is the goodwill on this acquisition? What will be the value of the goodwill on the acquisition? Okay. So let me just come here. So you can just count your workings. Whatever statement that you are doing, okay, whatever statement that you are doing, group structure is very important. Okay. So whether it is statement of financial position, statement of profit or loss, group structure is necessary. So the next thing that we have to do is to calculate goodwill on acquisition of, although they haven't asked you, but if there's a disposal that is going to be resulting in a loss of control, the goodwill will also be going. So you have to know the value of the goodwill. So what is our purchase consideration? How much are we paying for the investment over there? So this would be Guinea. How much are we paying? 90 million, isn't it? Okay. What is the value of the NCI? That was 50. So we have 140. What is the value of the net asset at acquisition? Would that be 114? Yeah, 114. Okay. So what would be the goodwill at acquisition for them? I'm having 26. Are we okay with that?
Yes.
Okay.
Yes.
Let's go to the B. Okay. So this one, we are doing disposal. Okay. There might be a disposal that will lead to what? Loss of control. So if you are losing the control, it means that the goodwill will also be given to the new company that will be having the control now. So you have to calculate the goodwill. But if there will not be a loss of control, maybe then the goodwill will be as impairment. So you have to calculate the goodwill and not the impairment. But I say no impairment is deemed necessary for the goodwill in Guinea. Let's count the D side.
ZP disposed of a 20% equity interest in Guinea on 31 March 2016 for a cash consideration of $44 million. The remaining 40% holding had a fair value of $62 million, and ZP exercised significant influence over Guinea following the disposal. ZP accounts for investment in subsidiaries at cost and has included a gain in investment income of $14 million within its individual financial statement to reflect the disposal. The net assets of Guinea had a fair value of $180 million on 1 July 2015, and this was reflected in the carrying amount of the net assets. All gain and losses of Guinea have accrued evenly throughout the year. The disposal is not classified as a separate major line of business or geographical operation.
Okay, but there's a reason for that, but we come to that one later. So we initially had what? 60%, isn't it? We initially had what? 60%, isn't it? All right. The reporting date is what? What is the reporting date for? What is the reporting date?
June.
30th June. So it means that these figures are for a year. This is profit or loss. They are for a year. So this is from 1st July 2015 to 30th June what? 2016. Okay, let's look at when the disposal was done. We had 60%. We have disposed 20%. It means that we are now going to be having what? 40%. We assume that the 60% are going to be owned by a person. So that person is the one having control. The 60% is not going to be spread among what? A majority of people that you still have control. Since nothing has been said about that one, it means that control will now be transferred to a different person. So we have lost control. But the disposal was done on which date? The disposal.
31 March.
Okay. So it means that the disposal was done 3 months to the end of the year. Is that correct?
Yeah.
So for the first 9 months, we are still the parent of what? Of the Guinea. So it means that we are going to have a 9-month share of their what? Of their profit. So you consolidate them for only 9 months. So we go here and now consolidate their figures for 9 months. So 9/12 multiplied by their revenue figure. So what is their revenue figure there? So we pick their figures one by one. Their revenue is what?
132.
Okay. So if you can be giving me those figures so that we can move fast. So revenue is 132. Their cost of sales is what?
Their cost of sales is 76.
Okay. What about their investment income?
The investment income is 19.
Okay. So what about the administrative cost?
The administrative cost is 12.
Okay. And the other expenses?
Yeah, other expenses is 18.
18. Okay. Then we now have their finance cost.
Yeah, net finance costs is 6.
Okay. You can also change the 9/12. If you change it to decimal, I'm sure you'll be having 0.75. So you can use 0.75 to multiply their figures. Nobody is going to. So 9/12 multiplied by their tax expense is what?
The income tax expense is 7.
Okay. Their gain on revaluation of property is what?
Again, it's 16.
Okay. So this is what we do. Okay. But the remaining 3 months, what will happen? They will be classified as an associate, isn't it? The remaining 3 months, which will be April to June, they will be classified as what?
Associate.
Associate. So what will happen is that if they are going to be classified as an associate, this particular profit is for a full year. So it means that we are going to be having 40% of the 3 months profit over here. So let's do that as a share of associate profit. So we'll be having 3/12 multiplied by what is their profit for the year? It's 32.
32.
Okay. So we do 3 over this multiplied by 32. Then all of this will be multiplied by 0.4. So we have the share of their profits for the last 3 months as an associate. The share of this particular gain also, we have 3 months as an associate. So 3/12 multiplied by what is their revaluation gain? Or they have 0. So we don't have any share over. No, it's not 0. It's 16. Okay. So we have the 3/12, then multiplied by 16, then multiplied by 0.4. Okay. So this will be, we have 9 months as a parent and 3 months now as what? As associates. Okay. So that is for that. But let's go to the B part where they are talking about certain issues there. Okay. Okay. So we have disposed them for 44 million, isn't it? Okay. The 40% holding had a fair value of 62 million, and ZP exercised a significant influence over Guinea following the disposal. ZP accounts for investment in subsidiaries at a cost and has included a gain in investment income of 14 million within each individual financial statement to reflect the disposal. So if they say we account for these people at cost, means that we put investment in associate in our financial statement as 90. Okay. If our investment in associate is 90, so let's calculate the gain that they are recognized in their statement of financial position. So let's look at the gain recognized, the figure that they have recognized, and the gain that's supposed to be recognized. So the gains recognized by ZP, okay, on the disposal. what is the gain that the question is talking about? They say that they carry investment at cost. So we are going to be having a cost of investment, which is same as the purchase consideration to be what? 90 million. Okay. Let's look at the 40% return. Okay. The 40% return. So this is for 60%, but we have sold only 20%. So what is the fair value of the retained interest? What is the fair value of the 40%? Okay, that would be 62. So we are having 62 remaining. So what is the portion that we are selling? What is the fair value of the portion that we are selling?
$28.
Okay. So what is the process? So this is how they have calculated their. So the process will be 44, isn't it? So we have a gain of 14. Okay, this is how they calculated the gain of the 14. So the gain on disposal, this was how it was calculated for 14. So they have the investment at cost. They are still having the investment as 90. So they have taken the 62 from it because we have 60%. We have 40, which is what the fair value is still 62. So we are retaining 62 of the 90, but we have sold 28 and we receive what? 44 million for that. So they say that ZP account for investment in subsidiary at cost and has included a gain in investment income of 14 million within its individual financial statement to reflect the disposal. Is that how they're supposed to calculate the gain? Is that how they're supposed to calculate the gain on the disposal? Is that how the gain is supposed to be calculated? Isn't it? Is that how the gain is supposed to be calculated? Okay. We are 22 here. Is that how the gain is supposed to be calculated? Okay. Is that how we calculate the gain on disposal? Please, can you hear me? Yeah, can you hear me?
Yes, we can.
Okay, is that how the gain is supposed to be calculated? Is that how we calculate the gain on disposal of a subsidiary? The answer is just yes or no. So you can choose to say the yes, you can choose to say the no. I will interpret it myself. Yeah, Auntie Emilia, is that how we calculate gain?
I saw one in one of the books, but what they did was they added the investments, the initial investments to the proceeds, that is the sales, before they took the fair value. But I don't know whether it was correct. But
But
after, is it?
yeah, you can talk.
That is what I saw. But after their calculation, I realized the answers they had was also correct.
Okay, okay. So the answer is no. That is not how we calculate gain on disposal, isn't it? Okay. This is how we have calculated gain on disposal right now, where we say that, okay, you look at the net asset at disposal, you add a goodwill, you take your NCI, the value of this one. No. So the gain have to be calculated on the disposal of the entire subsidiary. So what they have over there supposed not to be there. So you come and take the 14 million and now calculate the correct gain on the disposal for them. So let's come to the gain on disposal. So gain on disposal, what you are going to be having is that you have the cash process. What is a cash process? The cash proceeds is 44. Then you will now add the retained interest, the fair value of the retained interest. Okay, like how we have done that. So the retained interest is 62. Then we come and add the NCI at the date of disposal. So let's go and calculate the NCI at the date of the disposal. I have done that. We have shown this one here. Okay, how we got the 20 over here. That is the same thing. So cash proceeds, add the NCI, add the retained interest, subtract the net assets, subtract the goodwill, all at the date of acquisition. Okay, so let's come to the calculation of the NCI. How do we calculate the NCI here? Okay, come to this one. How do we calculate the NCI here? Okay, they are saying that the NCI at the date of acquisition is what? NCA at the date of acquisition is what? Is 50. Okay, that is 1st July 2014. Okay, come here. Okay, the net asset of Guinea had a fair value of 118 million at 1st July 2015. And this was reflected in the carrying amount of the net asset. All gains and losses of Guinea have accrued evenly throughout the year. The disposal is not classified as a separate line of business or geographical operation. What they are trying to tell you is that you should not classify the subsidiary, the disposal of the subsidiary, as a discontinued operation. It's not a separate or a major business line that we are disposing. If it should be a separate or a separate major business line, or or it is in a different geographical operation, then that will be classified as a discontinued operation. So we are not going to consolidate them, but we just find the profit or loss on the discontinued operation and send it to our statement of profit or loss. But they are saying that it should not be treated like that. It should not be treated as a discontinued operation. But that is not a problem over there. What is the net asset at the beginning of the current year? Okay, we know that the beginning of the current year is 1st July 2015, because the reporting date over here is 30th June 2016. So we are starting from 1st July 2015, and they are saying that the net asset over here. So we have to go and find the NCR at reporting, and also the net asset at reporting. So let's do small workings for NCI at the date of disposal. At disposal. Okay. So let's come to the NCI. What is the fair value of the NCI at acquisition? At acquisition, what is the fair value of the NCI? Was that 50 million? The fair value of the NCI at the date of acquisition was what? 50 million. Okay. The fair value of the non-controlling interest in Guinea was 15 million on 1st July 2014. Okay. What is going to be increasing NCI? What increases NCI?
Post-acquisition profit.
Okay. So what is the net asset at the date of, what is the net asset at the date of acquisition?
14.
Okay.
100.
115. 114, sorry.
Okay. What is the net asset at the beginning of this current year? What is the fair value of the net asset given to us in the B?
118.
Okay. So it means that the NCI at the beginning of this year is going to be the share of the post-acquisition profits. Okay. Which will be at the beginning, that will be 118 minus 114. Is that correct?
Yes.
Okay.
Yes.
Multiplied by 40%. That is at the beginning of this year. NCA will be having 40% of any profit that is made from the date of acquisition to what? To the beginning of this year. What are you going to be having?
$1.6.
Okay. 1.6. Okay. All right. This 1.6 now, this is NCI. So NCI will be 51.6 at the date of acquisition. But what will be the NCI at the date of disposal. It means the NCA will be having a share of 9 months profit again. Is that correct? NCA at the date of disposal, that will be 31st March. This is at the beginning of this year, which will be July 1, 2015. Okay. But the disposal is done on what? 31 March 2016. It means that the NCA will still increase by what? 9 months profit. NCA will still increase by 9 months profit. So that particular 9-month profit, what we do over here is that, okay, there's a gain on revaluation. So the NCA will have the share of the profit and also the share of the what? Of the revaluation. So 32 plus 16, what are we having? So share of PAP, okay, that will be from July to March 2016. Okay, so what will be the share there? Okay, the question says that you should assume that all the profit or loss accrue evenly. So 32 profit for the year is for 12 months. The 16 revaluation gain is for 12 months. But we are looking for NCI on 31 March 2016. That is 9 months after the start of the year. So what will be the total gain for them? 32 plus 16 is what?
48.
Okay. That 48, we are going to have 9 months of it, isn't it? And this will be multiplied by 0.4. So the 48 is for the full year, but we want NCI at 31 March 2016. So 9 over 40, 9 divided by 12, multiplied by 48. I'm having 36, multiplied by 0.4. I'm having 14.4. Is that correct?
Yes, please.
Okay. So what will be the NCI at the date of disposal?
$66.
66.
Okay. So we now go and have the NCA of 66 here. Okay, let's total our figure there. So we have 66 plus 62 plus 44. I'm having 172. So we can have 172 here. Let's bring the net assets. Okay, the net assets here. The goodwill has not impaired. So you always bring the goodwill at the date of disposal. So if there's any impairment on the goodwill, you subtract the impairment. We want the value of the goodwill at the date of disposal. So if there's any impairment, you take the impairment and bring the carrying value of the goodwill at the date of disposal. But this question says that there was no disposal of the goodwill. So we have the 26 million as the value for the goodwill. Okay, but we have to look for the net asset. Okay, how do we calculate the net assets? The net assets at the date of disposal, which will be 31 March 2016. Okay. Now what we do is that we have the net asset at the beginning of this year. So the net assets 1st July 2015 was what? 118. Is that correct? Okay.
Yes.
So 31 March, what will increase the net asset? 31 March, what would increase the net asset? What is going
PAP.
Okay, so the profit, the 9 months profit will increase the what? The net asset. And the 9 months will now be 9 over 12 multiplied by everything will be sent to what? To the net asset. So the revaluation plus the profit, which will give us 48. Okay. So 9 over 12 multiplied by 48. What are we having for the profit for the 9 months, which will increase there? I'm having 36.
Yeah.
So if you put it together, what are we having? 154. Okay. So our net asset will now be 154. Let's put the two together. 26. Okay. So I'm having 180. Are we having a loss or a gain?
Loss of $8.
Okay. Okay. So we have a loss on disposal. So not a gain. That will be loss on disposal. Okay. So this will be shown in our statement of profit or loss. So where we see the profit on disposal, it should actually be a loss. So loss on disposal. We can now erase this as loss on disposal. And that will give us 8. Okay. So we are done with that particular side too. We can now move on in what? In peace. Okay. Let's look at the C.
ZP acquired 80% of the equity interest of BOO, a public limited company, on 30th June 2014. The purchase consideration was cash of $60 million. The fair value of the NCI was calculated as $12 million at this date. Due to the tight reporting deadline, the fair value of the identifiable net asset at acquisition had not been finalized by the time the financial statements for the year ended 30th June 2014 were published. Goodwill of $28 million was calculated using the carrying amount of the net asset of BOO. The fair value of the identifiable net asset of BOO was finalized on 31 December 2014 as $54 million. The excess of the fair value of the identifiable net asset at acquisition is due to the plant, which had a remaining useful life of 5 years at the acquisition date. Due to the losses of BOO, an impairment review was undertaken at 30th June 2016. It was decided that goodwill had reduced in value by 10%. Goodwill impairments are charged to other expenses.
Okay. So when was the acquisition done?
30th June 2014.
So like this year, are we going to be having a full year share of the profit for this year?
Yeah.
We have 30th June 2014. That is 2 years now. So it means that we have been a parent for them for 2 years now. So it means that this particular year, which is the 2016 year, we were parent from the beginning of the year. So we just come and consolidate their what? Because we having control over them. So we consolidate this one by having 90 here. We add their figures. So what will be their cost of sales? Cost of sales is 72. Okay, so we add 72 here. Then what will be their investment income? Are they having any investment income? Okay, the
Yes,
investment,
they are.
okay, that is 5. So investment income is 5. Okay, do they have admin cost?
Yes,
Okay, how much?
8.
Okay, 8. Okay, operating expenses what?
Other expenses is 15.
Okay, 15. Okay, so what is their finance cost?
Yeah, finance cost is 9.
9. Their tax expense,
Income tax expense is 3.
is it positive or negative?
Positive.
Okay, it's positive. So that is a credit, not tax, isn't it? So you pay attention to
Yes.
that. Okay, so that will not be addition. That will be a subtraction because they are having tax credit. So that will be a deduction here. Okay, they don't have any gain on what?
Yes, they don't have any gain on property revaluation.
Okay, okay. So they don't have any gain. So that is for them. But what will happen is that there's something over there that we have to work for. Okay, let's come to their part of the question. Okay, you can see that we have something that we call the what? The measurement period. Okay, because of their tight reporting deadline, we were not able to what? To measure their net asset correctly. So we just use what? A provisional figures to calculate our what? our net asset for them. But look at this place. They say the purchase consideration was cash of 60 million. The fair value of the NCI was calculated as 12 million at this date. Due to a tight reporting deadline, the fair value of the net asset at acquisition had not been finalized by the time the financial statement for the year ended 30th June 20th June 2014 were published. Goodwill of 28 million was calculated using the carrying amount of the net asset of book. So let's look for the net asset that we use to calculate the goodwill at the date of the acquisition. What will be the net asset at the date of acquisition? Okay, they have given you the cash consideration and they have given you the goodwill figure. They have given you the what? The NCI. So what will be their net asset at that date? At the date of acquisition, what will be the net assets? Can someone give me the figure there? I have my own here, so confirm for me. What are we having? What will be the net asset?
72.
No.
Purchase consideration. Yeah. Yeah.
44.
Okay. So 44 is confirmed. Okay. How do we calculate the goodwill? The goodwill is calculated by adding. So let's count to the net asset. Let's calculate net asset of boom at the date of acquisition. Okay. So we have purchase consideration. How do we calculate goodwill? We have the purchase consideration of 60. We add the NCI, okay, of 12 to have 72. So we now take the net asset from this, but we don't know the net asset. We know that the resulting figure is 28. Okay, so you'll be having a net assets of this one. So you just subtract the goodwill from this one. It is the net asset minus what? The 72 minus the net asset that will give you the goodwill. Now you don't know the net asset. You just subtract the goodwill from the total of 72. That will give you the net assets. Okay. So it's just a small calculation that they are, small mathematics that they are asking you to do there. Okay. So that will give you 28. Then we have 44.
Oh.
All right. So let's come to what they are saying now. So the net assets at acquisition is what? Is 44. Okay. But let's come here. All right. Let's come here. Goodwill of 28 million was calculated using the carrying value. Okay. The fair value of the net asset of Boo was finalized on 31 December as what? 54. So what is happening now? The net asset is increasing by what?
By 10.
Okay. So if the net asset is increasing by 10, would our goodwill still be 28?
Oh,
The goodwill will now be what?
you reduce to 18.
Okay, the goodwill now reduced to 18. So you, after knowing the net asset, you now have to recalculate your goodwill because we use 44 to get what? The 28. So the goodwill will no longer be 28. Okay, so you have to recalculate your goodwill. How do you recalculate the goodwill? You just take the 10 from the 28, or you recalculate everything. So you just look at recalculation of goodwill. Okay, recalculation of goodwill. Okay, for Boo. Okay, so you still have your purchase consideration. You still have your purchase consideration. You have your purchase consideration of 60. So the NCI, we assume that the NCI will not be affected. Okay, the NCI will still be the 12. Okay, but if the NCI will be increased by the fair value adjustment, they will tell you. So we still say that the NCI is 12. That will be 72. So our net asset is now 54. So our goodwill will now be what? 18. So they are talking about impairment of goodwill there. So what will be the impairment of goodwill? Okay. Impairment of the goodwill. Impairment is 0.1, isn't it? Okay. So that will give us 1.8. So you can just find your remaining figure there. Okay. So they are saying that due to the losses of this one, an impairment review was undertaken at 30th June. It was decided that goodwill had reduced in value by 10%. Goodwill impairments are charged to other expenses. So the goodwill of 1.8, let's go and charge that to other expenses and come. So we now come and add 1.8 here. Okay. But let's go to the fair value adjustments. Okay. They are saying that the excess of the fair value of the identifiable net asset at acquisition is due to plants which had a remaining useful life of 5 years at the date of acquisition. Okay, we acquired them on 30th June. What is the reporting date? What is the reporting date?
30th June 2016.
2016.
Okay. So we now find depreciation. The additional amount will be bringing depreciation because that has not been taken into consideration. So they were charging the depreciation based on the carrying value. So the 10 million was not captured. Okay. So if we are capturing the 10 million, the 10 million will be captured from the date of acquisition. But we are now in 30th June 2016. It means that we have used 2 years out of the 5 years already. So we calculate the depreciation that will be charged on the asset every year. What will be the depreciation every year?
2.
That will be 2 million, isn't it? Okay.
Yeah.
So, but the accumulated depreciation will be 2 times 2 million. That will be 4 million. Okay. So if we are showing statement of financial position, the plant will be shown as 6 million in the statement of financial position. But what we are doing over here is that we are preparing statement for only 2016 year. So we take only the depreciation for the 2016 year to that one. You don't have to take the profit or loss is prepared for the year. Transaction that happened during the year. Not the transaction that happened from the time that the business started was operating. That is for statement of financial position. So what is the portion of the depreciation that relates to the current year? That will be only a year, 2 million. So we take your depreciation, then the question did not tell you how you should treat it. Okay. But what will happen is that most of the companies, they treat their depreciation as addition to cost of sales. So you just come and add 2 million to your cost of sales here as depreciation, not the 4 million. No, we are preparing this for only 2016. 2015 year, we don't have access to that one. So we just do the depreciation for this year, which will be 2 million. Okay, but let me show the calculation for that depreciation. So depreciation on the plant. Okay, depreciation on the plant will be 10 million, which is the excess amount divided by the remaining useful life. That will be 2 million every year. Okay, we have done that also. Okay, so there is nothing about them that we have to do again. Let's go to the D.
ZP holds D.
Yeah.
ZP holds property for investment purposes. At 1 July 2015, ZP held a 10-floor office block at a fair value of 90 million with a remaining useful life of 15 years. The first floor was occupied by ZP staff, and the second floor was let to BU free of charge. The other 8 floors were all let to unconnected third party at a normal commercial rent. It was estimated that the fair value of the office block was 96 million on 30 June 2016. ZP has a policy of restating all land and building to fair value at each reporting date. The only accounting entries for the year ended 30 June 2016 in relation to this office block have been to correctly include the rentals income in profit or loss. It can be assumed that each floor is of equal size and value, depreciation is charged to administrative.
Okay, so for this reason, we should go and take the cost of sales, depreciation to cost of sales now to administrative expenses. Okay, so we just come and take the 2 here and add it to administrative expenses. Okay, so that is for that. Okay, let's come to the okay. So let's come to this one. Okay, yeah. What are they talking about over here? This question is about investment property, isn't it? Okay, a property should be accounted for as an investment property if the property is being led towards a third party, independent third party. Okay, so there will be a situation where the property will be given to a subsidiary. But at the group level, the subsidiary is part of the parent, so it will be seen as owners occupied. So the property that is being occupied by the subsidiary will be accounted for as PPE. Okay, the property is also occupied by the staff. Okay, we are not renting the properties to the staff. Okay, in the best way, we are using the property to generate income. How? The staffs are going to be sleeping there and they wake up early and go to work. So if we are using the property for administrative purposes. So properties occupied by the staff of a company is also treated as a PPE because we are giving the property to staff of the company. This property will not be given to anyone else apart from you being a staff. So it means that we are using the property to run the business. The property is purposely for us to run the business because we are not giving it to anybody apart from the staff. So if you are not a staff, you will not get a property. So property occupied by staff and a subsidiary are going to be treated as what? As a PPE. But in the separate financial statement of the parent and then the subsidiary, it will be treated as an investment property. But if you come to the group level, the subsidiary is part of the group. The subsidiary is owned by the parents. So if you're occupying the property, that is owner occupied what? Property. So we account for it as PPE under the group level. So the 2 of the properties will now be accounted for as PPE, but the remaining 8 will now be accounted for investment property because they are given to an unconnected third party. So investment property should always be given to somebody that you are not connected with. It should be given to an independent third party. So 8 of them will be investment property, but 2 of them will be accounted for as PPE. Okay, at the group level, who bears the depreciation of the PPE is the parents, although it doesn't make sense because the subsidiary is the one that is going to be using the property. But at the group level, is the parent that is going to take the depreciation because the parent is the one classifying the property as PPE. It doesn't make sense. Based on the matching concept, it is the subsidiary that will be what? That will be generating revenue from that. So the depreciation should be matched against the revenue generated by using the property. But the standard says that parent should be the one, although it doesn't make sense. But you cannot be in Ghana here and be saying that it doesn't make sense. Okay. So what we'll do now is that we are having 10th floor office block. 2 is for what? 2 is used by connected people to ZP. So the 2 will be accounted for as what? As okay, as property, and 8 will be accounted for as investment property. So let's find them. Let's find their carrying value at the date. They are saying that it can be assumed that the building, they are of equal size. So it means that their value are going to be the same. That's what they are telling you. So let's look at the carrying value. Let's look at their carrying value for each of them. So the carrying value of the PP, let's look for the PP. Okay. So can we say that the carrying value is 2/10 multiplied by 90? Is that correct? The carrying value at 1st July, at the beginning of the year, can we say it's 2/10 multiplied by 90?
Yes, please.
Okay, that will give us how much? Okay, that will give us 18.
18.
Okay, so we have the investment property now. Let's find the carrying value of the investment property. Okay, that will be 8/10 multiplied by 90. What are we having?
72.
Okay, 72. Okay, the question is saying that the only accounting entry that has been made is to what? Is to report the investment income as what? As in the investment income. So no other entry has been what? Has been made on this. So the depreciation on the first two has not been charged. So we look at depreciation on this one. So what is the useful life of the property?
5.
No,
Hello?
the useful life is what? 15. Okay.
Yes.
Okay. The useful life is 15. So we have 18, which will be the PP over 15. How much are we having? We're having
1.2.
Okay. So we have 1.2. That 1.2 will be sent towards administrative expenses as depreciation. So admin, we have 1.2 as depreciation. Okay. What will be the carrying value of the assets here? What will be the carrying value at the end of the year? That will be 18 minus 1.2. Okay, how much are we having?
16.8.
Okay, 16.8. Okay, the carrying value of the investment property will still be 72. But let's go and read something that the question said there. Okay, they are saying that ZP has a policy of restating all land and building to fair value at its reporting date. So it means that for property, plant, and equipment, they are using revaluation model. For investment property, they are using what? Fair value model. So let's find the fair value for all of them. Okay. It was estimated that the fair value of the office block was 96 million at 30th June, which is the reporting date now. So let's look for the fair value for all of them. Okay. What will be the revalued amount for the, so let's look at the fair value, which is the revalued amount for the PP. Okay, fair value for PP, would that be 2 over 10 multiplied by 96?
Yeah.
Okay, how much are we getting?
19.2.
19.2. Okay, let's go to the fair value of the investment property. So IP, investment property will be 8 over 10 multiplied by 96. What are we having for them?
76.8.
Okay, so we have 76.8. Okay, so 76.8. So what is going to happen? We are going to be having a revaluation surplus. Is that correct?
Losses. Yes.
Okay, so that will be 19.2 minus 16.8. The carrying value at the value of the asset is 16.8, but they are now saying that it's 19.2. It has increased by how much?
$2.4.
Okay,
2.4.
2.4. Okay, so this 2.4 will be added to their revaluation figure here because no entry has been made for this one. So 2.4 will be added there. Let's count to the fair value gain on the investment property. So what will be the fair value gain on the investment property? The fair value at the date of this one is 72. Now it is 76.8. What is the fair value gain? Okay. What is the fair value gain on the investment property? Would that be 4.8?
4.8.
Okay. So we're supposed to show, okay, we don't have idea about that. So we're supposed to show a fair value gain. Okay, let me just put a fair value gain over here. Don't treat it as investment income because it's not income. Okay, it's just a gain. So you have to show it as a fair value gain or gain on investment property. Okay, so it's not an income. okay, is a gain. So gain on fair value of investment property. So you can just say fair value gain on investment property. That would be 4.8 as a gain. Okay. Let's go. We are done with that one now. Let's move on to the E. Okay, E.
During April 2016, an explosion at a different office block caused substantial damage, and it was estimated that the fair value fell from 20 million at 30 June 2015 to 14 million on 30 June 2016. ZP has estimated that cost of 3 million would be required to repair. ZP has estimated that cost of 3 million will be required to repair the block, but is unsure whether to carry out the repairs or whether to sell the block for a reduced price. The property has been left in the financial statement at a value of 20 million. A provision of 3 million for the repair cost was charged to other expenses.
Okay, so what are they talking about over here? So they say that there was during April 2016, an explosion at a different office block caused substantial damage, and it was estimated that the fair value fell from 20 million at 30th June to 14 million at 30th 2016. So this particular thing happened during the reporting period. So it's not an event after reporting date. Okay. ZP has estimated that the cost of 3 million will be required to repair the block, but this is unsure whether to carry out the repairs or whether to sell the block for a reduced price. The property has been left in the financial statement at value of 20 million, and a provision of 3 million for the repair cost was charged to other operating expenses. Even if we are sure of doing the maintenance, do we make provision for repairs? I is 37. Do we make provision for future repairs? Oh no, Senior, we have done 37. Do we make provisions for future repairs?
We don't.
Okay. Okay. The repairs can be avoided by selling off the property or the asset
Property.
before that time. So this provision have to be what? Have to be cancelled. So they have a provision of 3 million. We don't make provision for repairs, for future repairs. So let's go to their other expenses. We go and take 3 million over there because it's charged as an expense. So we should not make provision. So if you are doing statement of financial position, we also go to the provision or the current liabilities or the non-current liability, whatever they are putting it, then we go and subtract. We only wait till if the repair is done, then we now account for it as an expense. We don't make provision for future repairs. And the question is even telling you that they are not sure of carrying out the repairs. Okay, but what is happening to the assets? What is happening to the asset? We can see that the asset has impaired, isn't it?
Yeah.
Okay. The value has reduced from 20 million to 14 million. So the asset should now be stated at what? At the value, at the fair value now, which is 14 million. So we should charge impairment of 6 million to the statement of profit or loss. So if you are doing statement of financial position, the asset is still at 20 million. Then you go and take the 6 million from it to now bring it down to what? To the 14 million. Okay, we are not sure. The entity is not sure as to whether to carry out the repairs, and even if they are going to carry out the repairs, we don't make provision for what? For the repairs. So what we'll do is we will just put the asset at 14 million. If the repairs is done, then the asset will now be brought up to what? Its normal condition. Then we reverse the impairment of the 6 million. That's all you can do. We don't make provision for we don't make provision for future repairs because the asset can be sold before that time. So we come to other operating expenses here, then we add other expenses, we add the impairment of 6 million. If you are doing statement of financial position, you also take the 6 million from the property, plant, and equipment, because the question says the asset is still at 20 million. So you go and take the 6 million over there and now make it what? Make it to be 14 million. And if you are doing statement of financial position, this 6 million should be charged to group return earners because the asset belongs to us, to the parents. Okay, so that is for that particular one. Let's come to the F, which is the last one. Then we go our, okay, let's come to the last one.
Following information, sorry, the following information relates to ZP's defined benefit pension scheme. So net pension deficit on 30 June 2015, service cost for the year, contribution into the scheme, discount rate.
Okay.
Then we have remeasurement again in the year ended. No entries have been entered in the financial statement except that the contribution into the scheme have been correctly added to the pension scheme assets.
Okay. So yeah, so what this is about employees benefit, isn't it? Okay.
Yeah.
We are doing statement of profit or loss, or even if we are doing statement of financial position, they say no entry has been made. So what are the figures that you quickly send to the parent statements? What are the
Service
figures?
cost.
Okay, service cost will be added to administrative, which is 10. So we have a service.
Interest.
So we have to calculate the interest on what? On the figure there. But that one, since we have to calculate it, we have to wait for this thing and
Measurement.
okay. There will be a remeasurement gain of 4. Okay. That gain will be recognized in other comprehensive income. So you come and add the gain of the 4. Okay. So we are left with now calculating we have to now calculate our finance cost. Okay. So we have a remeasurement gain of 4 million. Okay. So the remeasurement gain of 4 million is already there. So what do we have to do again? Okay. What we send to statement of profit or loss is the service cost, the interest, and also the remeasurement gain. But they have given us a remeasurement gain already. So we don't have to prepare the table to show the closing balance. Okay. But we are going to show that if this is for statement of financial position, what figure are you going to be showing as what? As a net liability in the statement of financial position. We are going to look at that. Okay. The interest will be calculated on which figure? The interest will be calculated on which figure?
The 14.
The 14, that's the net pension deficit.
Okay. What rate are we going to be using?
10%, the rate at the beginning.
Okay. The closing rate will always be reflected in the closing balance. Okay. So at each reporting day, we will be discounting. So we use 10% to discount the pension liability at the what? At the beginning of the year or at the close of last year before getting this one. So the interest element over here is calculated by using 10%. So you apply the 10%. Okay. But at the end of the year, the actuaries has now discovered that the interest rate will now be 12%. So they will use the 12% to now give you the fair value of the liability at the reporting date. So the 12% has been reflected in the fair value of the liability at the reporting date. And that will be having effect. So they will be using the 12% to discount their closing balance for this year. Then in the next year, it means that the discounted factor is 12%. So you use 12% for that year. So you always use the opening rate. It is the opening rate that has been used to determine the liability at the beginning of the year. So what would be the finance cost over there? The net finance cost.
1.4.
Okay. 1.4. So you go and
Line up.
yes, yeah.
So if I get what you're saying, that means that assuming we are going to do it for 2017, then we'll be using 12% for 2017.
Exactly.
Okay.
So we have 1.4 as the cost. Okay. But this one, the question is not asking us to do, it's not statement of financial position question. So what we need is the figure that we need is the service cost, the interest. If there's any past service cost, we also send it there. But there's no past service cost. The question has given us the past service cost already. The question has given us the service cost, which is the additional benefit that is for the year. Statement of profit or loss, interest, statement of profit or loss. Assuming we were not giving the gain or loss, but we are giving the closing figure. That is when we are going to be calculating the gain. But they have given us the gain already, so we don't have to do any working for this one. We can just leave it and move on. But if it should be statement of financial position, what are you going to do? So this is why you have your net pension deficit at, so let's have the net pension deficit at 2016, at the end of 2016. So we always start with the opening balance, which is balance brought down on the account of 14. So service costs will increase it because we're supposed to pay additional benefit to them. So that will also increase their balance that they have with us. What is the service cost there?
8.
Okay. Service cost is 8. It's 10. Okay. Service cost.
10, sorry.
Okay. So we have 10. Okay. Let me see whether I've done use 10. Okay. Service cost to be 10, not 8 here. Okay. Okay. So the contribution to the scheme, the contribution will be an asset. So what will happen is our contribution will be a reduction here. Okay. We are owing the people. So if we make a contribution, but the contribution will be an asset. Let's count to the net interest. The net interest will be 0.1 multiplied by the 14. That will be 1.4. Okay. So what's supposed to be the balance there? 14 plus 10.
17.4.
Okay. 17.4. Okay. But they are saying that there's a remeasurement gain of what?
2.4. No, 4.
Okay. So if there's a gain, it means that the liability has reduced. That's why we're having a gain. So this will be 13.4. So the figure that you'll be sending to 2016, if you are doing statement of financial position, will be 13.4. But we are not doing that. So we only need a service cost, the net interest, and the remeasurement gain for the profit or loss, which was given to us already. So we just have to use those figures and move on. You don't have to do anything. But if we are to be given 13.4 as a closing balance, then it means that we have to calculate the gain ourselves. We look for the liability, the actual liability against the closing balance. It has reduced by 4. So that will be the gain for us. But they have given us everything already. So you don't have to do anything about that again. Okay. So that is it. I want to show the share of the profit. How do you share the profit? So after this one, how do you share the profit to them now? Okay, if you cannot share, you can just leave it and move on. Okay, but let's look at the share of the profit for the year. The share of the profit for the year. Okay, so we'll be having shareholding, the parent shareholding, and then the NCI. So we have the parent shareholding. So you can put the total figures together. So the parent holding and NCI. So let's count to NCI. We always start with the NCI. Okay. We are going to be having 2 NCIs, isn't it? Okay. Okay. The first one, the first NCI will be having 9 months. We can see that we are consolidating 9 months of what? Of Guinea. Okay. There was no post-acquisition adjustment relating to Guinea. Have we done any post-acquisition adjustment in respect of Guinea for this particular transaction? Were there any reduction or increase to their profit for the year? No. So what we do is that for the 9 months, NCL was 40% for them. So we come to the NCL for Guinea. That will be 9/12 multiplied by their profit for the year. Okay, that will be their profit for the year. So what is their profit for the year? The profit for the year is 32. So that will be 9/12 multiplied by the 32. That is the profit that we have consolidated. We consolidated for only 9 months profits. The NCA share is part. Consolidating for 9-month profit is that is the 100% of their trading. So parents will be having 60%, NCA will be having 40% for the first 9 months. So that is for the Guinea. Okay, you come to okay. Bull is a full year. We have consolidated Bull for the full year. Okay, what is the profit for Bull? It's a loss. It's a loss of what? 16. So that loss of 16. So we have a loss of 16. So that will be negative 16. Okay. Were there any post-acquisition adjustments that was not captured before getting that particular profit of 16? Okay, yes. There was impairment of goodwill. How much? Impairment of their goodwill is how much?
6.
Impairment of their goodwill for Boo, the subsidiary, is 1.8. 10% of the 18. That was 1.8. Okay. And there was also a post-acquisition depreciation. All those things will be what? Will be, so we have impairment of 1.8 minus what? The 2 million. So this will be multiplied by 0.2. Okay. So you just add these figures and put your balance over here. So the loss of 16, we should have subtracted impairment from their goodwill from the loss before we share, but that was not subtracted. There was what? Post-acquisition depreciation of 2 million, which is related to their plants. That was also not captured in the what? In their statement of profit or loss. So if these things should have been captured, it should have been a deduction to their what? To their profit or loss. And we have captured that now. We have captured the 1.8 and the 2 million. So it means that the loss that we'll be showing for them will no longer be what? The 16. It will be more than the 16. So what is the loss included in the statement of profit and loss? That's what we are looking for. So you always adjust it from the subsidiary level. So it will be their loss reported minus the adjustment that should have been done. Then that will give you the total loss. NCA will be having 20% because the parent is having what? The parent is having 80%. How do you find a parent holding? You just look for the profit for the year, what? For the year reported. So you take the profit after tax reported minus the NCA share. That will give you the parent one. Okay. Although you can calculate this, but this is the easiest way. Then you also count to this is only profit for the year. But what would be the gain on the revaluation? What would be the gain on the revaluation for them? What would be the share of the gain on revaluation for them? Okay, the share of the revaluation or the share of the total profit for the year will be the NCA. So you also start from the NCA calculation. So what is the NCA? It means that the total profit for the year is the profit for the year and the gain on the revaluation. So we have put the two together. So the NCA share of the total comprehensive income will be their share of the profit after tax plus their share of the revaluation gain. But let's count the revaluation gain here. How many of them is having a revaluation gain? How many of the subsidiaries is having a revaluation gain? It is only what? It is only Guinea that's having a revaluation gain of 16. But this one, NCA will have a share of only what? NCA will have a share of only 9 months. So you do 9/12 multiplied by 16, multiplied by the NCA share. NCA share of 0.4 because the last 9 months NCA is having NCA was having 40%. Okay, so that is how you share. But please, if you cannot do this share, just add your figures and move on. Okay, if you cannot do this share, just add your figures and move on. Just add these figures and move on. So the first 9 months, the parent was having 60, NCA was having 40. This is how we share it. So this is disposal on profit or loss. Saturday tomorrow, not Saturday. tomorrow we do statement of financial position. Then we start complex groups, maybe cash flow. Then that is the end. Please, any question? Okay. Please. So that is it. I'll see you guys tomorrow. Thank you all for coming. All right.